All right, you guys, welcome to the Young Investor Society 2022 Global Investment Symposium today. I'm Christine Tobin, Chief Operating Officer of YIS, and I will be your host. We have an exciting lineup for you today, but before we get started, I wanted to introduce YIS to those who may be joining us for the first time. Young Investor Society is an online enrichment program that provides quality financial literacy education and programs to students from all backgrounds and socioeconomic levels. We currently serve 8,359 students in 44 states and 26 countries across the world. Now, for our program today, I'd like to introduce the following speakers. David S. Lee, professor at the University of Hong Kong, will be speaking on fintech, blockchain, cryptocurrency, and NFTs. I also have Adam Nilsson from Morningstar, who will be discussing risk diversification and more specifically, how cryptocurrency can be part of a diverse portfolio. Next, we have Kelly Fuller of BMO Capital Markets discussing investment banking, followed by Suzanne Sarka from Paleo Capital, who will be discussing impact investing. And finally, James Fletcher, founder of YIS, will be joining us to talk about the progression of the investment industry. And we're going to be following up with each speaker with a couple of questions. So if you have any questions during the presentation, make sure you type them in the chat. I'll be selecting a couple of those for each speaker. And then we'll do some Q&A with the speaker. And then we'll follow that up with a trivia question for your chance to win a $10 Starbucks card. Make sure you type in your answer into the chat, and I'll be selecting from the answers in the chat. So now I'd like to introduce you to Mr. David Lee. David currently teaches at the University of Hong Kong Business School. He's an active in the areas of ethics, fintech, leadership, and governance. He also teaches a first of its kind massive online open course titled Fintech Ethics and Risks, which has registered over 12,000 students and has received a number of recognitions and awards. David started his career at Goldman Sachs and received his undergraduate education at Brigham Young University. He has a graduate degree from Harvard and the London School of Economics, and his legal training at UCLA School of Law. So let me go ahead and give it over to David.
Super. Thanks, Christine. And I guess for people on my side of the world, good morning. I'm in Hong Kong at the moment. I'm very far away in the kind of corner of my apartment because my kids are still asleep and I've got to get them ready to go to school. So I'm thankful for the opportunity that I have to go first so I can get my kids off. But one thing I'll promise you today, beyond what I'm going to say, is that all the talks will get better from here. So it's all going to be after my talk, everything else will be better. So Christine, I'm just going to share my screen. Is that all right? Let's see.
Yeah, you should be able to.
Cool. There we go. So, we don't have a lot of time, and I'm happy to answer as many questions as possible during the time we have together. As Christine mentioned, some of the classes I teach relate to fintech and blockchain, and I've been involved in venture investing here in Asia a little bit as well. Now, I just want to really talk about three things today. I just want to briefly talk about blockchain. I'm assuming many of you have heard this word before. You may not know exactly what it is. We'll just talk about it briefly. And then I want to talk about two kind of applications of blockchain, NFTs, which many of you are probably aware of, and then something called CBDCs, and we'll talk about that. But beyond just the technology, what I hope that you think, I hope what we think about or what you leave with from, kind of my little spiel here is this idea of what is value or what drives value, and then thinking about when you think about investing, think about, hey, what's next? What are the implications of whatever this technology is or something that happens, and then not just stopping there, but then thinking, okay, what are the implications of that? So if X happens, then what will happen after that? And that's a really important question that actually most investors and most companies and most organizations don't do well. Most people are good at thinking, okay, what's next? What are the implications of this? But then not thinking about what are the implications after that. Okay, so we think about that as like first order effects and then second order effects. Most people are pretty good about first order effects, but not so great at thinking about second order or third order effects. And we'll look at an example of this through one of the technologies that I mentioned. So most of you are familiar with blockchain, and effectively, blockchain technology has three kind of core concepts. It's a distributed ledger, so it's basically a record, right? That's digital, and it's a linked collection of these records. The idea is through cryptography and the how that recording occurs that those records cannot be changed, and so it's protected. And the last is that there's some transparency, and so meaning people who are on the block can see what's going on, right? And so a lot of times we think, oh, if it's blockchain, if it's cryptocurrency, it's completely anonymous, and that's not the case. For most blockchains, you can see the transaction. You may not exactly know who that person is, but you can see the transactions occurring, and that's the part of the record keeping. So blockchain can be used for a lot of different things, but we're going to look at two. So the first is, NFTs. And so let me actually share the screen this way. So if I was just to ask what's an NFT, most of you would probably be familiar with that, a non-fungible token. That's what it stands for. Uh, okay, so what really is that? The simple version of a non-fungible token is a digital collectible. So when I was younger, we had baseball cards that were in paper form. Now we have the equivalent of a baseball card that is in a digital form, right? And so, if we think about that, maybe some of the articles that many of you have seen show non-fungible tokens like some crazy price, lots of people trying to make money off non-fungible tokens. And so you wonder, hey, is that something I should invest in? Like, what's driving the value of that? And I know through the YS curriculum, one of the main things we think about is like, hey, how does like a stock, for example, where does it derive its value from? And so let's think of it this question. So I'm assuming most of you are familiar with this painting. This is the Mona Lisa hanging in the Louvre Museum in Paris. Obviously, if we were to say how much is this cost, like what is the value of it, most of you would probably say priceless, right? Okay. Well, here we have the Mona Lisa. You can go onto Amazon. I literally just did this a few days ago. You can go onto Amazon. You can buy a copy of the Mona Lisa off Amazon for $14.99. So what's the difference? Why is there a difference in price? Because you could go onto Amazon and get a really high quality copy, maybe by paying an extra $10. It's the exact same painting in the sense of like the image that it depicts, yet one is priceless, right? And the other one is, the cost of one or two books. So what drives the difference in how we perceive the value of Mona Lisa that's hanging in the Louvre Museum versus the Mona Lisa that you can buy on Amazon, right? And I'm wondering, does anybody have a guess what that may be? And if you do, you can just go into chat and drop your guess if you like. But we'll continue on as you think about that. Why is there a difference? Let's look at another example. So this is a year or two ago, shortly after Kobe Bryant passed away, the famous basketball star. So the NBA has gotten involved in creating these digital tokens. There's some comments in chat, so let me see. Historical context, and Rohit says maybe age or value. So those are really good, and those are good. That puts us in the direction of what we're trying to get to. So let's think of the example about this. So there was a digital token that was created that mimics a slam dunk that Kobe Bryant did, that LeBron James ended up doing as kind of a memorial after Kobe Bryant passed away. And you can find this on YouTube. Okay, so like the YouTube, there's a capture of that YouTube right there on the slide. Yet the digital token of the same video that you can see was sold for almost $400,000. So why would somebody want to buy a digital token, a non-fungible token, the digital collectible of LeBron James doing a slam dunk to honor Kobe Bryant versus that same video you can get on YouTube for free? So all of us could log on to YouTube right now and see the same video. We don't have to pay $400,000. So why are people paying astronomical amounts of money to buy something that is easily found online? Okay, and so now we're getting here to in some of your comments about originality being unique. So Rohit talks about endowment effect. So really, it's two things that are driving this, and this is something to think about. One is scarcity. So like in basic economics, we talk about this idea of scarcity, and that drives price. So there's only one original Mona Lisa. There are lots of copies, but there's only one original. So there's a scarcity premium that people are paying to be able to get NFTs. So similarly, when somebody creates an NFT, in theory, they're only going to create a limited number of NFTs, right? Now, there's no rule that says they have to follow that, though, to be honest. So people say they may only create a limited amount of NFTs, but in actuality, they could create more if they wanted in most cases. Now, as a result of that scarcity, that's driving value. And then related to scarcity, there's a psychological effect that occurs called FOMO, which many of you have probably heard of, fear of missing out. That drives a lot of our behavior, but particularly when you think about cryptocurrencies and NFTs and kind of this Web3 related, uh, technologies, there's a lot of FOMO. People are like, oh, like I saw my cousin, he made $1 million, like investing in Bitcoin. I can't miss out on that. I'm gonna get in now too. And so that kind of behavior then obviously drives price action. Now the question then you ask yourself, okay, so I understand the scarcity thing, I understand the FOMO thing. Does that mean what I'm paying for, I'm actually getting value for? And that remains to be seen. And so as you think about potentially in, evaluating such technologies, that's something to consider in the context of everything you're learning in your YIS curriculum. Okay, so that's one example of a blockchain technology. Now, the next example, and then let's have some questions if people have any questions, is CBDC. Now, some of you will be like, CBDC, that sounds kind of like the CBD thing we hear about, derived from certain plant. This is not what we're talking about. What is a CBDC? A CBDC is a central bank digital currency. Some of these are on a blockchain, some of them aren't. It's imagined that most of them will be on a blockchain in the future. And what that means is, like in the United States, for example, or in China, we have central banks that basically control the money supply. Increasingly, there are countries that are moving to non-paper forms of money and creating what are called central bank digital currencies. So here's an example of eCNY, or digital renminbi. So this is the Chinese currency. And China has started testing this very aggressively in the last, or developing and testing this in the last 2 years. Parts of the main parts of the technology so far are actually not on a blockchain, but it's envisioned that it eventually will go onto a blockchain. Now, why is this important? And why do countries pursue this? Well, there's lots of good reasons that countries pursue digital currency. One, they're able to control the money supply more efficiently. Two, they're able to minimize costs in terms of printing. It has less environmental damage. You don't have to replace paper bills all the time, so your frequency of replacing your currency decreases. You can clamp down on counterfeiting. So there's lots of reasons of why people or why governments may want to pursue a central bank digital currency. Additionally, it helps in seeing tax revenue. So people oftentimes try to rely on cash to avoid a record, but with having digital currency, it allows the government to kind of see what's going on. So then what's the big deal? What's the impact of this? So we talked about the first order impact just now, but what's the impact of this moving forward? And so this is maybe particularly interesting in the context of everything that's going on. There is a political and a geopolitical component to the rise of central bank digital currencies. And we're seeing this play out right now with Russia and the Ukraine, for example. So obviously with this horrific invasion that's occurring, we have this issue where many of the Western countries are instituting various forms of economic sanctions, financial sanctions against Russia. Now, one of the reasons the United States is able to do that is because most countries, their banks have to use US dollars in some form. And as a result, the US was able to create the playing field and set the rules for the financial playing field after World War II. And so for a country like North Korea, where there are no US banks, what that means is the US can exercise sanctions against any of these financial institutions because that they use US dollars, right? So even if that bank doesn't even have a branch in their country, right, or they have no connection to the United States, the fact that they clear US dollars allows the US laws to reach them. So in many respects, the United States is a sanctioned superpower, and we're seeing this play out right now. But what does a central bank digital currency have to do with that? Well, the next order effect then is countries are going to try to develop a financial ecosystem where the US will be able to not influence them as much. And so they're moving away from a US dollar. So the paper dollar is what the US can control. But if countries like China, like Russia, etc., are able to create a financial ecosystem where they can exist outside of the US's control of the financial system, then they'll be able to minimize impact of sanctions moving forward. And so this is just an example of where blockchain, one particular use of blockchain, and then thinking through, hey, what are the implications of this, and then what can happen next and next. And what I would just invite all of you to think about is through the NFT example, thinking about, hey, what drives value? And then secondly, through the central bank digital currency example, thinking about, hey, what is the impact? What is the first order impact? But what is the impact of that? And as you think about that, that'll help you kind of consider how you should evaluate investments for risk. It'll help you see around corners, so to speak. And that's just kind of high level what I wanted to share in my kind of 10-minute time that I had. And I realize I'm slightly over, so sorry for that, Christine. But I'm happy to answer any questions that anybody has.
Perfect. If you have a question for David, please put it in the chat.
Okay. All right, so these are some very profound questions. So Pranjay says, do you believe that the US abuses their power using SWIFT? Well, that's interesting. And so I guess the first thing to say is SWIFT is the protocols by which generally most banks transfer money, basically, right? And so does US abuse that power? I personally don't think so, right? I think the instances where SWIFT is used, like right now, where a lot of Russian banks are no longer able to transfer money using SWIFT. If you look at the kind of the history of how that's been controlled, I think most people would say it's been fairly fair. And so I personally don't think it's been abused, but certainly there potentially is the room for it to be abused. But the downside for abusing it is pretty high. So if you just use it arbitrarily, then people lose faith in the system itself, which is not what you want in finance. You mentioned the presence, so Luke's question, you mentioned the presence of blockchain, the Russia-Ukraine conflict. Do you see blockchain technology playing an increased role in these second order effects? Okay, so for that question, second order effect, absolutely. So what we're seeing right now is that there are cataclysmical impact of when countries pursue kinetic warfare, meaning like, I'm going to roll my tanks into your country. So Russia, before this conflict, was widely considered to have like a top 5 military in the world, equipment-wise, military size, et cetera, et cetera. We're quickly seeing that fall apart at the moment to a much smaller army that's less equipped, but that can fight an insurgent war effectively. And so what Russia and what the playbook that's also emerging is that I don't think most people assume that companies would move this quickly to basically unilaterally sanction Russia. All these companies that you see, all these name brand companies you see that said, hey, we're going to stop doing business in Russia. Like, no government is telling them to do that. Like, they didn't have to wait for sanctions for that to occur. They're doing that unilaterally in most cases. And so the second order effects, I think, are quite clear in that. And I think even if you think about how the Ukraine is raising money at the moment, they're using blockchain, particularly like different forms of cryptocurrency to raise funds, which I think we didn't really see in the past, right? And they're raising millions of dollars using cryptocurrency. So certainly, I think blockchain technology will play an increased role. And then sanctioned economic warfare, just in general, will play a big role in that. What applications do NFTs have beyond art? So if we think about the limited use of art, if you just think of like art painting, certainly within creative side, there are a lot of applications to like music, videos, digital art, traditional art. So there's that. I think anytime you want to record something, right, as a creative, that will apply. But then that theory could apply to anything that you want to capture some value in, right, and record your ownership. And I think that's interesting. I think more broadly, the thing about NFTs is this notion of you're putting more control in the hands of the artist. So right now, if Luke, for example, created a painting that he wanted to sell, the traditional way is you'd have to sell it directly or go through some sort of art gallery and go through the typical art industry. Now, through an NFT, a creator is able to control that whole process and do it themselves, right? And so in situations where you're trying to record ownership and then allow the creator of whatever content that is to control the ownership, that's an application. And let me just look at these last few questions. Okay, so Rhodes asking, can CBDC really overtake Bitcoin's relevance to cross-transaction? So the short answer is that, Rohit, absolutely, because countries can always shut down, at least within their borders, obviously. And you said internationally, but if we just think about China, for example, you cannot use Bitcoin in China for legitimate transactions. That's it. That's not saying you can't somehow access a Bitcoin and use it and sell it and mine it, though that's heavily cracked down on right now. So anytime, if in a hypothetical world, if countries if they want to heavily regulate Bitcoin at the to benefit their own central bank digital currencies, they could. But really, the reality is central bank digital currencies are going to be much more efficient than your typical Bitcoin transaction because of they're just going to be faster to be able to execute transactions. So one of the big criticisms of Bitcoin right now is the protocol only allows a limited number of transactions like per minute versus like a central bank digital currency. And so the ease of use and efficiency of use will give it some advantage in certain situations. And lastly, okay, so Pranj's question about decentralized versus centralized. This is like the heart of fintech and Bitcoin and blockchain, all this stuff, is the notion that all of these things are decentralized, so there's no one central control. The great irony of all of this is that all of these technologies now, and let's say the blockchain, is then being used and it's becoming now centralized, which is kind of one of the reasons they were formed, is so things would be decentralized, so they wouldn't be subject to like control by one particular government. And it would be very interesting to see how this conflict arises, this tension gets resolved over your generation, over the next 30 years, in terms of technologies that were designed to be decentralized, but will become increasingly centralized and regulated. And so that remains to be seen. But that's a great question, and I'm glad you're thinking about it. So on that note, Christine, let me end here. I thought these were great questions, and I'll turn it over back to you.
Perfect. Thank you so much, David. I knew that your session would be a hot topic. So Adam is a manager research analyst for Morningstar Research Services, which is a wholly owned subsidiary of Morningstar Inc., and he maintains coverage of a multi-asset and alternative strategies. Before assuming his current role in August 2019, Milson was a data research analyst with Morningstar's Data and Development Center, where he led the activations and client response squad. Previously, he was a client services representative for Morningstar Direct, the firm's investment analysis platform, and he holds a bachelor's degree in finance from the University of Cincinnati's Carl H. Linder College of Business. Without further ado, here is Adam, who's going to be presenting on risk diversification, and more specifically, how crypto can be a part of a diverse portfolio.
Hello, everyone. And Christine, thanks for the introduction. Let me go ahead and share my screen here. Hopefully everybody can see that. All right, great. Well, like Christine said, going to be touching on diversification here, risk diversification. And I guess the first thing to kind of touch on here is, what is risk diversification at a high level? Why should you care as an investor? And really, it's essentially allocating your investments across individual investments, whether it's industries, sectors, asset classes, regions, countries, and the idea being trying to maximize your total return while limiting the amount of total risk you're actually taking. And this example here is trying to show is just moving from essentially a single stock portfolio where you have zero diversification, and using Twitter as the example, a company we probably all know pretty well, and kind of moving through what we would consider more of a broadly diversified portfolio. So moving from Twitter to kind of the next piece would be, okay, all large cap equities, maybe in the US, and moving from the different sectors. So having some holdings in technology to financial services, communication services where Twitter falls, to energy and so on. So you're moving from that single stock to maybe a broad basket of stocks. And then from there, moving into, okay, maybe a more broadly diversified portfolio where you're looking at both international and then US stocks versus maybe just US core bonds. So kind of bringing out from equities into a broader asset class like fixed income. And then moving into, kind of a more broadly diversified multi-asset portfolio where you're moving, within specific areas of equities and fixed income. So now you're not just looking at large cap stocks anymore, but you're also looking at mid and small cap stocks. You're also looking at US bonds, but you're looking at international bonds. You're looking at real assets, high yield. So you have a lot of opportunity there to kind of diversify your risk. And at the end of the day, that's what you're looking for in being able to kind of spread your investment across a multitude of different areas versus just into one single stock. So now diversification, just diving into this a little bit more with kind of a real world example. So it's really putting all your eggs in one basket. So I just pulled 4 names from the S&P 500, commonly so known. So Twitter is one of those, Meta platforms, which is formerly Facebook. You have Bath and Body Works and Under Armour, kind of four known names. So if you look back 5 years ago, and if you would have invested $1,000 in any of these names, 3 of the 4 would have netted you a gain. Now, depending on which one it was, maybe Bath and Body Works would have been, 400 or so. If you look at Twitter, it would have been 1,500. So you're more than doubling what you put in, and that's a nice return, obviously. But if you look at Under Armour, you would have actually lost money over that time period. So you do have a lot of volatility in what you're picking, as well as kind of over that 5-year period. Can you stomach those returns or that volatility in your return stream over time? So if we think back to early 2020, when COVID emerged, we saw a lot of speculation on what was going to happen. Everybody was kind of uncertain, and we saw a lot of market volatility. If you would have owned these names, you would have averaged a 46% loss from late February to late March. It's a pretty big loss over that time period. And if you would have owned Bath and Body Works just alone, you would have lost 62% of the value in your investment. So that's a lot of volatility that you would have to actually kind of hold through to see the long-term return over the 5-year period. And it's not even just over maybe a month that you would see these kind of big or wild swings. You can even see it intraday. So if you look back to February 3rd of this year for Meta platforms, it actually lost 26% of its value in one day. So if you would have looked in the morning and then looked at the end of the day, there goes, a $1,000 investment, 250 more than that of your actual dollar worth. And that's just on pure, essentially a revenue forecast is lower than what the market expected. So having that single stock exposure with no diversification, you can definitely kind of get whipsawed back and forth over time. So then if a single stock portfolio isn't necessarily what you would want, you want to diversify that risk across more investments, how should you think about it? So kind of think of it as a risk profile in 2 areas. You have your risk capacity. That's essentially how much risk can you afford to take to meet your goal. And then your risk tolerance. And that's, what can you actually stomach? Are you more risk tolerant? Are you more risk averse? So risk capacity, you're looking at your investment goal. What's the time horizon you have for it? What's your income level at the time? Your amount saved, things of that nature. And then on the risk tolerance side, you're really thinking about kind of those general questions of, if I would have made an investment and lose, that 26, 30% value over time, is that something you can stomach? Or is that something maybe you would start pulling your money back a little bit? And all of that together kind of shows where you fall on the risk spectrum. So on the risk spectrum, you can think about it as that 100% equity portfolio, all the way down to maybe a totally risk averse 100% fixed income portfolio. And most people on this call here are probably going to be very much in the 100% equity side of things. You might have a little bit more risk aversion here or there, but if you think about the long-term horizon that you have, retirement's a long way away. You have that ability to actually work through some volatility. So with that, it's a good way to kind of show now, like, yes, you could have a single stock portfolio. We've looked at the volatility, but maybe it makes more sense to diversify that risk across that broader portfolio. So here, I'm just trying to show, what would it look like if you had a 4-stock portfolio equally weighted across those 4 names? And how would that done versus just investing in kind of a broad market S&P 500 ETF? And you can see on the return side of things over that 5-year period, sure, you might not have returned as much as you would have with Twitter, about 3% less annualized over the time, but your risk-adjusted returns and the volatility you would have felt over that period is a lot less. So you look at standard deviation here, it's more than 1/3 of what you would get through Twitter. Sharp ratio, a pretty common risk-adjusted return metric. You're looking at something that's pretty substantially higher than what you would have with Twitter. And really kind of one that stands out here is the drawdown. So we talked about some of those big drawdowns you can feel over some of these more volatile periods. And here, with just using the S&P 500 ETF, sure, the biggest drawdown, 32%. I mean, that's something definitely notable. But if you compare it to some of those single stock names, it's half that. So it is easier to kind of stomach through. And gives that opportunity to diversify your risk away from that single stock into a multi-stock portfolio. So then we kind of move on to broader asset classes. So most of you, like I said, probably 100% equities, but down the line, you probably will start to venture into some safer areas of the market that provide additional diversification benefits. And really, when we're thinking about that, that's into fixed income. And that's into some of those areas that we talked about on the first slide I showed. So what are we looking at here? And really kind of the foundation around some of kind of your diversification outside of just one asset class are the correlations. And correlations meaning, how are these different asset classes moving with one another? Are they perfectly correlated? Do they move in unison one way or the other? Are they perfectly negative correlated, -1? Are they moving exactly opposite? Or are they falling more around that 0 range where they really just move independently and they don't have much of a relationship? And you're trying to, when you're kind of diversifying your risk and building a multi-asset or a broader portfolio that's allocated across many different asset classes, this is what we're looking at. So I tried to throw a couple in here just to give an example. So if you look at column 1, you have the Morningstar US Market Index, which is just a broad index of US equities, and you compare that to some of the specific sub-asset classes within fixed income. So your core plus bonds, your treasury bonds, high yield bonds, you can see some of those correlations. US treasuries having a negative correlation, core bonds and treasury inflation protected securities having lower than a 0.4 correlation. So those are providing those diversification benefits that you're looking for when you're building kind of a broader asset allocated portfolio. So what does that look like kind of in real terms? So at a high level, if you look at just kind of your standard 60-40 portfolio, a lot of people talk about it. Is it dead or not? Either way, you look at the top end level, and all 3 of these portfolios, 2 from the same firm, Vanguard, and 1 from a different firm, would look very similar from a top end. But once you look under the hood, they look very different. So for Vanguard Balanced Index, you'd have a 60-40 portfolio of US stocks and US investment grade bonds. But if you look at their Vanguard Life Strategy Moderate in their target risk series, they go a step further. The US stocks and bonds, you're getting that exposure, but then you're getting the international exposure as well. And then if you look at MFS's moderate allocation fund, same 60-40 at a top end level. But then when you dive in, they're going even deeper. They're looking US stocks, international stocks, but they're also adding a commodities exposure. They're looking in US bonds, but they're adding core bonds and high yield bonds. They're adding international developed bonds and emerging market bonds. They're really going deeper, and you're getting more diversification through that portfolio. Is one way more correct than the other? No, it really ties into the strategy, what they're trying to deliver, the time horizon they're trying to do it in. but there are a lot of different ways that you can diversify your risk in the portfolio across various asset classes. And then lastly, just to touch on some the crypto side of things. So Mr. Lee touched on this a bit here, but what could crypto look like in a diversified portfolio? And for kind of more popularity's sake, we'll look at Bitcoin specifically, or that's the one I'll focus on. So undoubtedly, we've seen pretty high flying returns. If you look back to say 2020, Bitcoin posted an over 300% return or around that. If you look back to 2017, it posted, over a 1300% return. So pretty eye-popping numbers there. But if you look at the volatility you're getting, so in that first chart that I threw up there, that is the rolling 1-year standard deviation of the CMBI Bitcoin index relative to just a standard 60/40 portfolio, think Vanguard Balanced Index. On average, it's about 12 times more volatile than just a standard 60/40 portfolio over the last decade. That has come down some, but it could go back up. It essentially sits around that threshold. So when you add it to a diversified portfolio, that 60/40 portfolio, even at just a 5% threshold, it does have a major impact into what you're returning. So if you think about just absolute returns for those portfolios, you're looking at roughly 16% over the last decade on an annualized basis for a 60/40 with a 5% Bitcoin allocation versus just a 7.5% return for a standard 60/40 portfolio. So you're getting double the return to add in a slice of Bitcoin, but at the same time, you're getting a lot more volatility. So if you look at the last 5 largest drawdowns for Bitcoin over that period, so you can see those at the bottom of the chart there, you're looking at, upwards of a 92% drawdown at times. If you look at how that impacts your 60/40 portfolio in those periods, on average, you're losing almost 8% more having that allocation in your 60/40 portfolio. So it's something to keep in mind as well. You are getting those high flying returns, but it does come with a lot of volatility that, over the long haul, you have to kind of stay within to actually experience those returns. So hopefully that's helpful. I know I hit more on the general diversification piece of it than the crypto side of things, but happy to answer questions. I know I ran a little over on time there.
No worries, Adam. So if you guys have a question for Adam, please type it in the chat.
Let me run back here. Let's see. So Pranja said, as per my understanding, when looking at investments through the lens of capital asset pricing, it's always preferred to invest in all asset classes, no matter what the expected return. This would in turn reduce your volatility. How does that interpretation hold in the real world? I think that definitely is a good point. And, I think some of it does kind of revolve around the fact of, what is your end goal? If you are looking, if you have a 65% or 65-year time horizon, 100% equities probably does make more sense for you, but it is more of an individual kind of person by person, investor by investor. But when you do move through, I mean, at some point, is there over diversification? There could be. If you look at some diversified portfolios, they may be holding, multiple investments in certain areas that have a lot of overlap that's unnecessary. So you can see that as well. But that is a good point. Let me pull down here a little bit more. Luke said our portfolio optimization theory is still relevant given society is incredibly volatile. That's also a good point. Some things, I mean, at the end of the day, no one has a crystal ball, and that is something that is hard to counteract. Right now, if you look at the fixed income markets, they're having a pretty difficult time, as so are the equity markets, and that's something we haven't seen a lot of. So it is an evolving kind of time where not everything specifically applies, I guess. So that is a good point, Luke. Most theories can still apply, but things are moving quickly and rapidly. Rohat said, how does balancing risk work with options trading? Options trading is definitely something that we see a lot of managers do within our group, and using options to pull out some of the risk, whether that's shorting certain indexes to reduce risk. So there are a lot of different options that you can do to reduce risk within your portfolio. It does add a lot more complexity that you have to be aware of with all options. I mean, you are pulling out volatility, but if you don't know exactly what you're doing and managing in the right fashion, it might not necessarily play out exactly as you had imagined. But that is something that you can do to help balance risk, is use options. And Sebastian, is it better to diversify in an investment portfolio around different asset classes, or can you get the same diversification benefit hedging your portfolio using derivatives? You can. That's a good point. It kind of goes to that same kind of point I made there for Rohit. But options trading is something that you can use to diversify your portfolio. It also does help pull down risk if you're using options, whether you're getting in and out of an asset class. It does help if you're using options to rebalance quicker, move in and out quicker. So that is something that you consider as well when you're diversifying, but for just kind of broader purposes, keeping it high level here. And then Pranja said, can you share your personal thoughts on futures of equity research jobs in the next decade or two? I can try. I am not on the equity research side, actually. So it's a different group at Morningstar. I'm on the manager research side. So we focus on strategies like mutual funds, exchange traded funds, separate accounts, things of that nature. I would say, I guess on the equity research side, I don't see anything changing much in my view. I think at the end of the day, there's a lot more focus on some of these non-traditional asset classes. We have a group at Morningstar that is actually focusing more on non-traditional asset classes. So I see that coming. So I think the time is evolving and where you can focus and be more niche is definitely something I could see in the future that maybe there wasn't as much of a focus on in the last decade.
Perfect. Thank you so much, Adam.
Thank you.
Really enjoyed your presentation today, and I'm sure the students did as well. Next up, I have Kelly Fuller. Kelly comes to us from BMO Capital Markets, and she has 20 years in career in finance and is the managing director and leads the education technology services at BMO Capital. She spent the last 15 years focused on the education industry with clients including McGraw-Hill, which sounds familiar because most of your textbooks are written by McGraw-Hill Education, Renaissance Learning, Ellucian, and Weld North Education. Mrs. Fuller also led a STEM-focused education technology startup that was sold to Carnegie Learning. She also has a Bachelor's of Science from the Kelley School of Business at Indiana University and an MBA from the University of Chicago Booth School of Business. Kelly will be speaking on investment banking today.
Great, thank you, Christine. Appreciate it.
You're welcome.
Apologies, I don't have a deck prepared. So I was just going to talk a little bit about what do investment bankers do, sort of what does a career path look like, and then sort of walk through a real life example, some current deals that my team and I have worked on, and sort of what the role of you as an income would be, and what you could kind of expect in that role. So what do investment banks do? So investment banks, we work with clients on a couple of different things, on mergers and acquisitions, and also debt and equity raises. So on the mergers and acquisition side, you can sort of think of us as being similar to real estate agents. However, we obviously are assisting with the buying and selling of businesses versus housing, versus houses. And buying and selling a multi-billion-dollar business is a little bit more complex than a home purchase. So we advise on the valuation, how it should be structured, et cetera. And then on the debt and equity side, on the equity side, we work with clients to raise equity capital, and obviously debt. We work with clients to raise debt. So if you're a private equity firm buying a business, you want to finance part of that with debt, just as if when you're buying a home, you're going to go to the bank and get a mortgage. It's very similar, although the magnitude of the dollars is much larger. And obviously, for each of those services we provide, we earn a fee, which is why we're all in this business. And in terms of sort of what investment banking professionals do day to day, it certainly depends on your level and your role and what your seniority is. And just to talk a little bit about the hierarchy or how you progress within an investment bank, you enter from undergrad as an analyst. If you are really great and really strong as an analyst, you can get promoted to an associate. We also hire from MBA programs into the associate role. Then the progression is vice president, director, and managing director. And the roles are obviously different with each level. The analysts and associates, I would say, are more involved in creating PowerPoint materials and valuation analyses. So a lot of time in PowerPoint and Excel. We do a lot of pitching, and there's a lot of support you do on live deal execution. Once you become a vice president, we call it sort of the quarterback of the deal, really leading the charge and an integral part of the communication between our deal team and the client. And once you get to the director and managing director role, our job is really more focused on building relationships. So it becomes more of a sales focus. We're the ones responsible for bringing in the business that the VPs and the analysts and associates then execute. I would say in terms of sort of how you think about the types of skills and the type of work that you would be doing to see if it would be interesting at all for you. It does require a lot of, again, financial modeling and valuation work. So a lot of time in Excel. We, as an analyst, you would be the person in charge of building, a 5-year forecast for a company we're selling. So you're the person on the phone with a CFO or their vice president of finance at the company, really helping to vet out those projections and what the model looks like. And then translating that into a valuation of the business. How much is it worth? How should we communicate that to buyers? Again, a lot of pitch books and presentations that I then take to a client and present ideas to. And then as we're running a process, there's just a lot of documents that need to be prepared. If we're selling a business, we prepare a whole deck on here's why you should buy the business and here's why you should pay a premium value. So what are the investment highlights? What is the growth strategy of the company? What is it they actually do? And what is that model that you built? What does that look like? And then you really work with the buyers and the company as they're working through their diligence. What do we like about the company? What questions do we need to get answered? We need to help them answer those questions. So that's at a high level what investment banking is. Again, I thought it'd be helpful to sort of talk about recent transactions. And as Christine mentioned, McGraw-Hill is one of our biggest clients. And hopefully you all recognize the name from your textbooks. We just advised on the sale of McGraw-Hill. It's owned by a private equity firm for $4.5 billion over the summer. And it's been a client for 10 years. And we are now, talking to new owners about taking them public. So sort of the life cycle of a company. And as I think about what our team had to do in that sale process, and going back to some of the things I talked about, we kicked off the sale process last February, so over a year ago. And we worked with the management team for about 3 months to develop what the pitch deck for McGraw is that we were going to send out to the private equity funds that we were going to talk to about the business, working with the chief financial officer on the 5-year projections, and really beating that up with the team to prepare them for conversations with buyers. So why do you think the business is going to grow 5% this year and not 3%? And why do you think you're going to generate, X amount of cash versus Y amount of cash? So a lot of our job is preparing the management team for those types of questions. So we then, once this, 80-page deck is done, that's, why you should love McGraw-Hill, and there's a lot of reasons to love McGraw-Hill. We pick up the phone, the senior team members, and we start calling the buyers. And then we send out the book. And then about a month later, after we've had more conversations with them, we've answered their questions, it's an auction process and they submit their bid. And we pick from those who bid, who is bid high enough to get moved into the next round. In that next round, you get to spend, 6 or 8 hours with the management team. And we had to build another presentation for that meeting. So in the background, you were still working with the management team, building sort of that next level of information, that next layer that we're going to allow buyers to dig into. We prepare what we call a data room. So it's all kinds of every document you can imagine that's about their corporate structure, all their legal structure, every monthly board reporting package the last 3 years that we're all putting in this data room. And then we ask for a final bid. So after another month of work, we ask the buyers to submit, here's your best and final offer. And then we negotiate along with lots of lawyers, all the legal documentation that goes around that. So we can then announce the transaction. And then parallel to that, because I mentioned that there's mergers and acquisitions, debt and equity. We are working on the debt financing, which is a whole nother work stream that we run parallel with the buyer. So that's a different group that we work with that helps us, get all the credit approved and figure out, well, how much debt is too much debt, or how much debt is the right amount of debt to put onto this business, and work through that process. So we've done a lot with that business. It was a really interesting process, I think, for a junior team. And that's a high level of what we do. I know that's only been half my speaking time, so happy to answer, open up to answer questions. I will say investment banking is a lot of work. When you come in as an analyst, the expectation is you are working, 80 hours a week. But I will say, I think the reward is very high, both financially and from a career development perspective. If I look at where our analysts have gone, some of them are still at BMO, some have gone on to private equity, some are working on the corporate side. We had one guy go work at Chewy. He was a very early on employee at Chewy before it was sold to Amazon. We've had people go to Harvard and Wharton and University of Chicago for business school. So it opens up a lot of doors and a lot of different career paths, because it is sort of a finance boot camp that you go through for 2 or 3. So that, I know I saw a question pop up, and I'm going to try to figure out how to get to it. Let's see, the first one: while researching various financial career paths online, many websites. Oh, yes. So I will say it is true that you are working, 70 to 80 plus hour work weeks. I will say all the banks do, I think, a better job managing that. There's just better technology now that makes the job a little bit more manageable. And most banks, including us, we have what we call protected Saturdays. So from 8 p.m. Friday to 10 a.m. Sunday, that is your time. And we have to get an exception to allow to basically for you to work during those hours. And the bar is very high. Like it is my fault if I have not planned ahead, and therefore I'm requesting you to work on the weekend. And most of the time in that scenario, I am told, no, just work it out on yourself. Sorry, I don't know how to get to the.
Oh, that's okay. I can read it for you.
Yeah.
Ryan asks, is there a difference in how you value a private company versus how you value a public company? And also, did you enjoy your experience at Booth, and would you recommend it to potential students?
Yes, thank you so much. the ways we value them are the same in terms of we do what we call a discounted cash flow, and we will look at their peers. So we call it comparable company analysis. So if public company A is trading at 10 times earnings and company B is trading at 12 times earnings, why is there a difference? So the methodology is the same. I would say typically what we see in public companies is you expect to have to pay a premium to the current share price, but that's typically because the public company is deemed to be, for whatever reason, undervalued currently, because maybe they're undermanaged, they've been underinvested in, and so that's typically be seen. In terms of Booth, I loved my experience at Booth. I thought it was incredibly rewarding, both academically, from a career perspective, from a social perspective. Met fabulous friends that were, as a very also career oriented. So I would highly recommend it. What I would say is, typically people work 4 or 5 years before going to get their MBA, and I found I did, and I found that to be very helpful in terms of just getting more out of the coursework, because you have more life experience and more career experience to sort of bring to the table and bring to the conversations.
Perfect. So Pranjay wants to know if you have any advice for trying to break into investment banking. From what he's heard, there's a large focus on prestige when trying to get a job at a firm right out of college.
That is true. I mean, every bank has their sort of focus schools, and there are certain schools that have what is called investment banking workshops that sort of prepare the students to get a job in banking. So if that's what you would like to do, I would look at which undergraduate business schools have those types of programs. And a lot of those business schools will talk about it on their websites. If they have, investment banking workshop or a big undergraduate finance major, because they do realize it's a big recruiting topic. Outside of that, and we go to schools like Indiana, Michigan, Illinois, Wisconsin. All the Big Ten schools have really good programs. Villanova, and we actually recruit at Baruch in New York. They have a really strong undergraduate finance program. Outside of that, it's just a lot of networking, because most banks also have pretty strong referral programs. I would say particularly around diversity recruiting. So, we're all trying to find great candidates, and those aren't necessarily always from the finance programs. What we also find is, yes, the job is a lot about crunching numbers day one, but as you progress in your career, a lot more of it is about critical thinking and strategic thinking. And a lot of times that isn't necessarily taught in a finance major. So that's why we do look at liberal arts majors, econ majors, because we actually want that diversity in thinking, and that diversity in educational background in our analyst classes. So there's, obviously the quote easiest way is to go to a school that gets recruited from a lot. And most of the big state schools do, I would say. Other than that, it's a lot of networking to get into it.
Perfect. Vandy wants to know, would you say that your line of work focuses on working with buyers or analyzing different assets and securities?
I would say it's both, and it's different by in terms of the role. I mean, most of my job right now at my level is actually, yes, talking to the buyers and actually potential sellers, because I want to get hired to sell their assets. But the way I get hired is by knowing who the buyers are and knowing how they're thinking, knowing what's going to make one buyer maybe pay more than another buyer, and being able to position that asset differently to different buyers and showing that knowledge. As an analyst and associate, more of your time is looking at specific companies that sort of, I asked you to, like, hey, we're going in for a pitch to sell this company. or I'm meeting with company XYZ, can you please help me get up to speed? Or again, if we're pitching, I need you to do the valuation work so we can go in and know this business is worth $1 billion, versus $1.2 billion. So as you progress, your focus sort of shifts and changes.
Perfect. One last question. How has the large scale shift towards remote work affected the investment banking industry?
Surprisingly, not as much, I think, as we all thought. We all thought the world obviously was going to shut down 2 years ago, and we all remarkably shifted to remote learning pretty well. In last 2021 across Wall Street was one of the busiest years ever. So from just a work productivity perspective, it really, I mean, I feel like I'm more productive at home. I think the area where we need to work on going forward is we have all these analysts that started during COVID that I've never met in person, and they've never met each other in person. And the analyst and associate role really is an apprenticeship model. Like you learn from each other, you learn from the second and third year analysts, you learn by sitting in on calls with me and listening to those conversations we're having with buyers during a process. And a lot of that has been lost because of COVID, because I could, before COVID, I could run out of my office and just say, hey, Kelly, I'm having a call with, Blackstone, come sit in and just listen in. And that's gone. Now we're going back, to a hybrid model. So hopefully that, we get some of that back, but I do think that that's been tough. Just the learning curve, I think, has been more difficult for analysts the past 2 years because you're just not there in person. Yeah. So I'm hoping it is.
That makes sense. Thank you so much, Kelly, for being here today. We really appreciate it.
Thank you, Kelly. Amazing job.
Thank you. Appreciate it.
Guest comes to us from Paleo Capital. She is Suzanne Sarka, and she's the founder and CEO of Paleo Capital, which is an impact fund and impact accelerator. The impact platform that creates financing solutions and invests taxable and philanthropic funds to accelerate data-supported research and measured impact on social change, which is largely focused on health with PPE equipment, housing, education, arts, and environment. So without further ado, here is Suzanne. Sorry, Suzanne, you're on mute.
Gotcha.
There you are.
There we go. Perfect. Okay. So you can hear me fine? Great. Well, thank you, Christine. And hello, everybody. This is a kind of a unique experience to speak to all of you and have this opportunity. So I was asked to speak about impact investing, and it's kind of ironically recently within an alumni group that from my university, we actually just held a program on impact investing called Unpacking Impact Investing. And I named it this because I think that there's a lot of question as to what impact investing really is. And there is in fact not one simple answer, because I think, a lot of groups have evolved with their own interpretations and their own elements of incorporating it into either their investment policy or into their own program. And so what I wanted to do today was to just create some sense of the paradigms of how to look at the space of impact investing. I think a lot of you come from different backgrounds. Some of them are very equity driven and very focused on corporations and what I would call the more liquid capital markets. And so I wanted to start in that context, and then I wanted to take it to another extreme, which is the area that I work in, which is much more focused on structured debt and one-off transactions that we've been built into higher, much greater applied transactions as we get scalability. And we eventually take illiquid products and bring them into liquidity into the capital market. So what I kind of thought I'd start out with was what I think most people know as ESG, which a lot of people would argue is not impact investing, but is in fact the terminology that came out years ago of environmental, social, and governance as a more conscientious, objective tool to measure activities within a corporation and their policies. Environmental representing companies that act more of as a steward of nature, and have policies that are conscientious about, whether they create pollutants or other activities that are bad for the environment. Social, representing how a company manages social relationships with either their employees, their suppliers, their customers. And governance, looking at issues that relate more towards the leadership, the executive pay, internal controls, and shareholder issues. So that really evolved as an element of looking at corporations and how they govern themselves and manage their day-to-day policies, and led to kind of a development of B Corps, and much of that is expressed in a more liquid capacity of the capital markets and would be known in just the stock investing that I'm sure most of you are familiar with. Many of these projects and products, and I'm just going to pull up a page here for myself since I've kind of outlined my little talk. Many of these products have kind of function on a spectrum. And so when we look at ESG related issues, we think more of traditional investments that you would run into on a regular basis and through more of the popular modes of investment. As we move down the spectrum of the curve, we start moving into transactions that are more quantitatively measured for their impact, and as opposed to things that are objective means of measurement, more quantitative. And that really delves into impact investing. And with that came various discussions around the Sustainable Development Goals of the UN. There are 17 of them, and it allows investments to really focus. It's a means of calibrating how investments are aligned with the values that produce impact that are less nebulous and more measured. So what I think I run into a lot of people who ask me, what are the different perspectives to look at an impact investment? And as I look at it from 3 dimensions, really. I look at it in the context of returns. And what I was going to do today is take you through, and how much time do I have still? I take you through those 3 perspectives. And if we could create a graph, it would be 3-dimensional. The 3 perspectives in which I view impact, and how what Paleo is doing differs, which, Paleo is just one expression of impact investing. And so it's by all means not the rule and not the majority, but it is a different perspective. And I think my perspective is very much against many of the traditional norms. So, the first thing that you would look at is returns. And so what are you expecting as an investor to get back from your investment? If you're expecting market returns, standard market procedure would say, okay, you're probably investing more in ESG related and more market return liquid products. And as I go down the spectrum of, do I want to take concessionary returns? Do I want to take a lower than market return? And let's say invest more in mission related investments, MRIs. There are many acronyms in this marketplace. I would look to expect maybe a lower than market return. It would typically be, as I look at my second dimension, where does it stand on the liquidity scale? In other words, can I get in and out? Is it going to be something that trades on an exchange? Is it more like private equity? Is it going to be something that's in the alternative bucket in the course of a fund or an opportunity zone fund? And then as I go down the spectrum, then I move into what would eventually become philanthropy, right? I can move into then grants and situations where I know I'm not going to get my money back. So that's not just even getting my money back with no return, but I'm going to get none of my money back because I'm granting it. And that would be purely philanthropy in the philanthropy category. And so the first dimension that we would look at as one of our 3 dimensions of our graph per se is the returns. So market down to grants, where you don't even get your capital back. The second is investment types. So am I looking at expressing my interest in impact in the equity market? And if so, am I choosing companies? Am I choosing mutual funds? Am I choosing stocks that have certain status indicators that they either maintain certain policies, whether it be they're a B Corp or it's a mutual fund that only invests in funds that have total green inputs into their corporation's manufacturing, et cetera. Moving down the scale, however, I can then look at things like, as I was saying earlier, private equity, venture capital, venture loans, and going into the debt side, loans, social impact bonds, where the outcome of the underlying impact as it's measured then affects whether the bonds have either an interest rate or a principal return. And that's kind of the area where very alternative, difficult classes, or let's say, I actually don't call them asset classes, I call them social and structural problems. And many of the tools, let's see, can you hear me okay? I just got it unstable on my thing here. Can you hear me all right? Okay. Where many of the problems that Paleo focuses on don't have any type of investment liquidity available to them. So what I do is I go in and I actually build either a piece of debt, a piece of convertible debt where it would be converted, it would be a debt up until a certain point, and then if the metrics of the payoff system don't conform over time, it converts into equity, and I basically become an equity investor in the program. But it's predominantly through debt. And those types of alternative investments have no liquidity. And my goal is to not to try to sell the instrument, but to take the pieces apart over time as it gets scalability and bring them into the capital markets to then sell out and be able to bring liquidity to the problem. An example would be some housing markets don't have the full amount of debt that they would need. And so how do we provide that debt and then bring it into a more conventional marketplace to enable it to enjoy the standard liquidity of the debt markets that exist behind mortgages and other things. So, and then the third paradigm that we look at, which I've referred to in all of these capacities and all of these different things, is liquidity. So, can I trade it? Am I stuck with it? Do I have to hold it to maturity? And what is the goal that allows me to get liquidity? And in Paleo's case, the goal that allows Paleo's investments to get liquidity is outcomes that change policy. And so the products that I am going after are products that are really based out of research. We know we can apply them. We know we can scale them. When it comes to really scaling them, our success is really that we can change policies so that they become market standard. And that's how we get our liquidity down the road. But that takes years to happen. Let's see, am I supposed to admit someone here? I did. So sorry. And so, again, the three spectrums that we're really looking at are returns, investment types, equity, debt, and the vehicles that they take, and liquidity. And conventional impact would say that if you are doing things that are not necessarily creating significant measured impact, you end up with low returns, very illiquid investments, and they're more alternative. And what Paleo is trying to do is change that norm, because I fundamentally believe that if you're doing good in society with the investments that you're creating and you're solving societal problems, you should be compensated. In fact, you should be compensated well above the market. And if we want to actually turn upside down the scale as to incentives that properly bring investors to the table, we need to create investment vehicles that pay properly on the market front for the activities that they're actually achieving. And in addition to that, by creating these kind of newer investment vehicles that we eventually bring into more liquid environments in the capital markets, whether we break them apart and bring in and sell out pieces as they reach market capacity, we are enabling things that were not liquid in the past to kind of be boosted into the point where they in fact can be liquid. So the third kind of piece of this is, in order for this to happen, and how I view what's imperative for the world of impact investing, is I view the world with different types of balance sheets. And with every balance sheet comes a different set of toolboxes. And so I've had a very eclectic background where I started out in mortgage trading, mortgage structuring and trading, moved into currencies and commodities structuring for esoteric assets and derivative-based assets, and then moved into fixed income structuring and equity structuring for derivatives and new products, and predominantly accessing balance sheets globally for different types of things we were trying to fund that had no liquidity. And what I realized years later, and through that course ended up getting brought through the municipal arena. And what I realized at one point was, we have these extraordinary toolboxes amongst these different types of balance sheets throughout Wall Street. And if we could take those and put those together to really solve societal problems, I think we have all the answers. It's just that many people don't see the different balance sheets and how to play with the tools and the different toolboxes so that they support each other as opposed to working in silos. And so from my perspective, I draw from a taxable, what people would call the standard capital markets. I guess stepping back for a second, affecting change with these societal problems will take much more than philanthropy. But so then how do we bring the capital markets to them? And there are two big marketplaces within the capital markets. There's the taxable and there's the tax exempt. And then as we look towards the kind of third marketplace, we've got the balance sheet of public policy, which deals with CDFIs and CRA related and government related programs that allow funding to create access to low cost of funds to be able to bring leverage into our portfolios. And then we've got the philanthropic balance sheets, and those can be whether they be grant-based foundations, donor advised funds. But if you look across those four balance sheets and you ask yourself, what are the different tools in those toolboxes, and how can I build a facility to address a specific problem, and then in a larger scale, bring leverage to it enough that I can create an interesting return that's safe for my investors, but also accomplishes with attractive returns what I need on the impact side. And that is what I do with Palio. And I don't know how much more time I have here. Christine, how am I doing?
You're doing great. If we wanted to get a couple of questions from our students. So if you have a question, please type it in the chat. And I can read those if it's easier. So Pranjay wants to know, can you give us some examples of these newer investment vehicles and how they introduce liquidity into places where liquidity has not existed in the past?
That's a great question. And so these, I mean, I know my own more than I know everybody else's, but a lot of these, well, so I'll give a very, very straightforward example. Social finance, for example, has a significant number of social impact bonds that they've put out there where they've measured outcomes, and their the payoff of the security or the loan, so to speak, is a function of the outcomes that are being measured for the transaction. So that's a very basic vehicle. They've done this in many different applications. The nonprofit organization has done these as well. Some of the investment banks, America has done some, Goldman's done some. They typically call them social impact bonds or outcomes-based investment vehicles. Many of those are one-off, but some of them, in fact, deal with programs that then get funded on a broader scale and then brought into other communities and then get funded through municipal related debt. And so that brings to the point of, you know, a program like that ended up getting structured from and funded in some cases with a piece of catalytic capital up front and then taxable capital, and its takeout down the road is municipal capital. And so seeing how that timeline can develop with housing, some of these projects can be, what is the derivatives and how does it work? Okay, that would be a whole class, but I'll give you a couple examples. Another example would be in the housing market. How do we take housing situations that are not funded? And I mean, you read about the ones that are funded, but you don't read about the ones that aren't funded. Why aren't they funded? They're not liquid. They don't have enough market presence to be bought out in mass if there's a downfall. The rating agencies won't give them a rating such that they'll fit on a balance sheet for whether it be an insurance company or an institutional balance sheet that could be able to quantify or qualify its returns. So for example, does it have a rating? Where does it stand on the capital chain so that they can calculate a total rate of return for that investment that's going to be within the balance sheets, the bank or the balance sheets bogeys and targets. A lot of these kind of structural things stand in the way of some of the most straightforward housing issues that would change low-income housing. How do we pamper that in its early stages, bring it beyond that, and then bring it to the fact that we can bring Freddie Mac and the GSEs, the more Fannie, Freddie, some of the larger, government-related entities, into the funding scheme and bring them therefore to market liquidity. So that would be an example of reaching market liquidity.
Perfect. Suzanne, how have global/international commitments towards climate and net zero business actualized in and affected the investment landscape?
That's a big question. How global international commitments towards climate. And so I guess the question is from corporations or if in fact as investments? And I'd love to draw on my colleague David Sonnen to help me out here, Dave Hood rather, since that's what he does for a living. Global international commitments towards climate are, I mean, I guess I'm probably not the best person to speak on that since my investments have not yet lent as much towards that. I look at my focus so far within the sustainability environment has really looked at carbon offsets and how do we quantify carbon offsets and incentivize carbon offsets to create additional offsets down the road. And so that's less of an investment vehicle from this perspective. I think that investments in solar and investments in a lot of the technologies, have become significantly more abundant as the necessity to reach goals that states and governments are requiring down the road. I mean, that is extremely abundant at this point. I think. I don't want to try to make up an answer on that question. There's a lot of great opportunities, and I think that each one is very different depending on what type of climate direction you're going. So I don't know if I passed on that question or not.
Well, thank you so much, Suzanne, for being here today and sharing all of your impact investment knowledge with our students.
Well, thank
Amazing
you.
job, Suzanne. Thank
I
you.
appreciate it.
Well, thank you all, and congratulations on what you're doing here. This is a fabulous direction. I really appreciate it.
And that leads me to my next speaker, which is our very own James Fletcher. James, of course, is the founder of Young Investors Society. He's over 17 years of investing in emerging markets with a strong history of alpha generation and fund performance. Most recently, he is the founder of Ethos Investment Management out in Salt Lake City, Utah. Previously, he was the director and senior portfolio manager of a $1 billion emerging markets small and mid-cap fund at APG Asset Management out in Hong Kong. And so without further ado, I will introduce James Fletcher, who is going to be speaking about his progression in the investment industry.
Well, thank you, Christine, and kudos to each of you for making it until the end. I know it's been a long but great time together, so thank you for being here. I'm honored to be able to speak. Let me put up my slides about progressing your career. And as you heard in the intro, I recently launched my own fund this year. So after 17 years, it's been a dream to launch my own fund. So I believe a lot of you had questions of sort of how I got to that point, and how the stages of your career can build to the point where you can launch your own fund. And so I'll walk you through some of that today. Today I'll show you some pictures. I'll give you some advice. I'll give you some book recommendations. And at the end, I also have a exciting announcement for you. Okay, so let's go through a couple of these slides. So how old was Warren Buffett when he started his investment partnership? So put that in the chat. And and let's see, how old, any guesses? How old was Buffett when he started his investment partnership? All right. I believe some of you may have seen me skip this slide ahead. But good guesses. So he was 26 years old. So one, that's pretty remarkable how young he was. The second thing I guess I'd like to, bring up is that even though he was young, he had made money personally. He had invested in stocks since he was 11. He had gone to undergraduate school. He had gone to business school at Columbia Business School. He had been mentored. And so even though he was young, he had fulfilled a lot of the steps that we'll talk about, which get you to that point. So yeah, Buffett is one of the inspirations for me. Maybe we've talked a lot about finance today, so I just wanted to show this. Why are we excited about careers in finance? Well, we're swimming in a wave, which is the capital markets. And the capital markets are driven by the stock market, which over a 20-year rolling period of any 20-year rolling period in history, the stock market has been positive. And so you look at this natural, rapid current that you're on, it tends to make for a very good industry. So, we've talked about impact investing today, and investment banking, and fintech, and all of these are part of this gigantic wave, which is the stock market and growing corporate earnings and finance. So that's what makes this industry so attractive. And even though we'll go through down periods like we're going through this year, and there's risk and there's concerns, I guess the message I want to leave with all of you is, if you choose finance as a career, you're choosing an industry that has natural long-term growth, and you're swimming downstream in a very powerful ocean. Why a career in investment management? So, a couple of reasons. You can make money, sometimes a lot of it. Your day is never boring. You get to travel the world. I've traveled to over 30 countries, paid for by my corporations. You get to know a little about a lot of sectors, and you get to spend time with some of the most interesting and smart people and companies in the world. So, this is me with Mr. Evans Bronco Jr., who's the family owner of the largest cookies and crackers and snacks business in Brazil. And, this was me in Fortaleza with him. And you get to meet just some of these business leaders from all over the world. Pop quiz, in terms of making money, and I wouldn't say this is the primary reason you should go into finance, but on average, portfolio managers make 0.5% of the assets that they manage. So, my former bosses that I worked with were managing a $10 billion fund. How much were they making a year? Put that in the chat. What was 0.5% of 10 billion? All right, you guys are on the ball. So it's about $50 million a year that they were splitting between the two of them after paying expenses and fund fees. So I wouldn't say this is the reason to go into this industry, but there certainly are areas to earn money and give back and make a difference through those wages. Here's a busy chart, but I just want to give you a flavor. So in this current of finance that you're swimming in, which is vibrant and growing And there's lots we've learned about today from some great speakers. You'll hear two terms, sell side and buy side. Sell side is investment banking, loan syndication, capital markets, equity research, sales and trading. These are, great careers. And then you'll see on the buy side. So these are, you can be stock investors, you can be venture capital investors, you can be fixed income investors. And then on top of all of this, there's M&A, there's lending, there's operations, there's syndication, there's sales, there's marketing. The point that I want to emphasize here to you is that within finance, there's so many different opportunities. And for your personality type, whether you're an extrovert or an introvert, there's almost certainly an ideal job that will fit sort of your mix of, quantitative versus qualitative and personality. And so I've been very blessed and very fortunate to be in this wonderful industry of finance. Okay, so here is a career progression. And this is obviously very simplified, but this is, how it played for me. So first was to develop a passion. Hopefully you've all, Young Investor Society students, gained a passion for investing or stocks or certain sectors or impact investing. Then high school graduation, a university degree, internships as you're going to school, and then you land your first job. If you're going into, especially on the buy side, I would recommend a CFA designation, and then becoming a portfolio manager. And for me, then launching my own fund. So there's been a number of steps that have gotten me here. Just as a aside, here is me below in the deepest gold mine in the world in South Africa. And there is me in the largest steel pipe in the world that's in Russia, that houses giant quantities of natural gas. So, fun experiences. I just want to tell a quick story, which I think you may find relevant. So I was going to school. I went to school at Brigham Young University. I was studying finance. I had a passion for investing. I loved Warren Buffett. I was investing in stocks on my own, and I wanted so much to break into the industry, but it's hard. And a lot of you know that it's quite challenging to get that first internship. There was a guest speaker at our school. He was a hedge fund manager from a fund called Nightwatch Capital. And he came and spoke, and I went and talked to him afterwards and introduced myself. And then afterwards, I followed up and I said, I am just so passionate, so hungry. I would love to do anything you would like me to do, put together pitch presentations. If there's ever anything that you would like some grunt work to do, I am happy to do it. You don't have to pay me. I would just love to learn from you. His name was John Nemelka. And about a couple of weeks later, one of his analysts emailed me and said, hey, I heard you're interested. Would you be willing to listen to conference calls and take notes? And that's it. Just listen to company earnings calls, take notes, and send it to us. And I said, absolutely. Thank you so much for the opportunity. And, that was my first industry experience. And then after that, I took a class and learned how to create a financial model. And I got my first full-time internship over the summer. And then that turned into a full-time job. So, those internships are important, and putting yourself out there, having the passion for it, was one of the keys to break into the industry. Let me give you 4 pieces of advice that have been meaningful in my career, and I would just share with you. And a lot of these pieces of advice are taken from books that I've read. So I'll highlight some books that go along with them. The first is become an expert. So whatever field you go into, whether it's finance or not finance, or whether it's, venture capital or impact investing or investment banking, become an expert within that field. So hard work, there is no substitution for. I'm a believer in Malcolm Gladwell's 10,000 hours, which is, what it takes to become an expert in a field. I recommend this book by Cal Newport. It's called So Good They Can't Ignore You. why skills trump passion in the quest for work you love. And basically, he makes the point that, we say follow your passion, but really you're passionate about things that you're really good at. And, putting in your time and becoming so good at something will make you passionate, but it will also make you very valuable within that career. So I recommend putting your time in early, becoming an expert in whatever field you're going into. And really, there's no substitute for hard work. Recommend Principles by Ray Dalio, who one is an expert himself in just how he analyzes macroeconomic events, but two, he lays out principles for learning and continual feedback loops, which I think are very valuable as you continue to grow. Second piece of advice, be a giver. So what do I mean by this? Give to your networks, give to relationships, give to your employer. Let me give you one secret as an employer. When I look to my analysts of which ones I want to promote, one of the common questions I ask myself is, what analyst makes my life easier? By the work that they do, by the recommendations that they make, but also just by doing all the things around the edges. I will tell you firsthand, when I was raising capital for my fund and we raised $100 million, which was our goal, a lot of the partners and investors were conversations from 10 years ago, or a friend of a friend who I had done something for 5 years ago was referring me to this allocator, and they came in as my seed capital. So invest in relationships. You never know when it will pay dividends down the road. So be a giver and invest in relationships. They're your most important asset. Third one is adapt and grow. So I recommend a book called The Education of a Value Investor by Guy Spear. I think many of you have read it. It's a great journey along the path of investment management. Guy Spear spoke to Young Investors Society and is a friend of ours. But basically being able to adapt investment philosophy, business models as you grow. And then I just personally love The Alchemist as sort of your search for your personal fulfillment and goals in life. And the fourth one, just quick, is be ready for when your chance comes. So a lot of career is preparing yourself for years, and then all of a sudden that opportunity in a snap presents itself and you are ready to jump. You're ready to take the risk. You're financially prepared. You have the skills, you have the experience. And so it's putting in that years of work and then taking the chance. I remember sitting with Paul Smith, who's the CEO or former CEO of the CFA Institute. And he said, his advice to me was, James, most people get one chance in their life, one remarkable chance. And if you're lucky, you may get 2 or 3 or 4 remarkable chances in your life. And the key is when they come along, when that person or that opportunity comes along, that you're able to take the risk, you have the experience, and you're ready to take those chances and those opportunities when they come. So, recommend Shoe Dog by Phil Knight. It's just a wonderful, it's an incredible book, but just reading how Phil, went through founding Nike and all of the pivots that he had to make, but all the risks that he had to take to establish a company as great as Nike. And Simon Sinek's The Infinite Game is one of our favorites, but talks about investing in purpose and creating values that is an infinite loop rather than specific goals that you accomplish and then you're done. So just quickly, summary: become an expert within the field. Don't be afraid of rolling up your sleeves and putting in your 10,000 hours and hard work as you're growing your career. Be a giver. You never know when those relationships are going to pay off down the road. Adapt and grow. Our industry will look very different in 20 years. And, hopefully all of us can continue to adapt and grow. And then be ready for your chance when it comes. The last thing we like to say is this year, the winner of the 2022 Global Stockfish Competition. One of the prizes, in addition to the cash prize, which Christine, have we announced the cash prize? Do you want me to announce it?
We have.
Okay, good. So the winning team wins $5,000, $2,000 in stockpile, and $3,000 in cash. In addition, the winning team will be offered a paid internship at my fund. This, like I talked about earlier, my first internship in asset management was life-changing for me. And so it's giving the opportunity to the next generation. And if the first place winners can't take it, then the second place winners in the Global Stockfish Competition will get the opportunity. So encourage you all to participate and wish you all luck in the Stockfish Competition. I'm happy to answer any questions. I know we're running late on time, but I'm happy to answer any questions you may have. Yeah, I just am so proud of each of you and am grateful for your participation in Young Investor Society.
Excellent. Thanks so much, James. If you have a question for James, please type it in the chat. And James, we actually have 10 minutes, so we're doing great on time.
Okay, excellent.
All right, Rohit. Rohit wants to know, is it okay to start building connections and relationships in high school? How can we learn more about careers through internships right now?
Yeah, absolutely, Rohit. So I would say your two most valuable times in your life are during high school and during college. It is so easy to email someone, connect with them on LinkedIn, and just say, I'm not looking for a job. I would just love an informational interview of 10 to 15 minutes of your time, just to learn what you do and just any advice. I think, you know, there's so many in our industry that love to give back, that would be happy to speak with you. And so take advantage of the time when you're in high school and when you're in college, when you're not, you know, directly asking for a job, when you're building those relationships. I'd say those windows are your most valuable time in your life.
So James, Ryan wants to know, what drew you to the finance industry?
Yeah, I mean, I a couple of things. I mean, one, like I talked about, I read Buffett when I was 16 years old, and it just completely turned my life upside down. I mean, it just made so much sense, and value investing and long term and good businesses. I just loved it. But I'd say even still, even though I loved investing, I wasn't sure I could make a career out of it. So I was personally going to major in accounting and go into accounting and then corporate finance and then business school. But what someone told me, I was a missionary in Brazil. I fell in love with living overseas and different cultures and languages. And it was just a small comment, but some professor told me, you know, investment management actually has much more international opportunities than accounting or corporate finance. And after that, I said, you know, I'm going to go for investment management. So I really went for it after that. So that was that second desire to live overseas and have international experiences. And as you saw in my pictures, I traveled to 30 countries and had so many, I've probably met over 1,000 CEOs in my career from all over the world. And, you know, I've been very blessed to be part of this industry.
Perfect. So Irgen wants to know, what would you say are the best resume experience and knowledge builders to prepare for that first internship?
Yeah, so it's tough, right? That first internship is hard because you don't have prior experience. The good thing is you guys are all doing Young Investor Society, and that's why we formed Young Investor Society. So you can put that on your resume. You'll have a stock pitch recommendation that you can send, and they will just be wowed that a high school student prepared a stock pitch analysis on a company. But I would say, honestly, when I'm hiring someone junior, I'm looking for one thing, and it's passion. I'm looking for hunger and passion. And so, you know, what are the signposts of that in the investment management industry? They invest personally. They have their own personal stock portfolio. They're passionate about the stocks that they've invested in. They're reading investment books. They're reading Howard Marks' latest memo and Bill Ackman's latest memo. And when I find someone that has that passion, even if they have no experience, I'm very likely to hire them.
Perfect. Ryan wants to know, what is the process for raising money to start your own fund?
It's one of the most difficult things about starting your own fund is raising money. But it's also one of the most critical things for long-term success is having the right long-term clients, right? So I may have a great long-term view on a company, but if a client pulls out money after 6 months, then it doesn't matter if I'm right 3 years from now, right? So you need to find the right clients. I would say for me, I needed to have an investment track record that was credible. So I have a 17-year sort of track record of investing. Early on, I'd say you do want to start with sort of credibility and, a strong team that can help, and for me, starting with a strong team and, working for a good reputable firm really helped. And then third, for me, there's always that risk, right? There's always that leap that you have to do into the deep end. And so, I officially launched with $30 million. So it was that jump in the deep end, and then, was able to build that client base after that.
Excellent. What is the focus of your fund? Value investing, impact investing, et cetera?
Yeah, so we're invested in emerging markets, which is all of the countries in the world outside of developed North America and developed Europe and Japan. So the largest markets for us are China, India, Brazil, Southeast Asia, Thailand, South Africa. Our focus is on quality businesses, and we also take an ESG integration approach. So we have ESG scorecards that we run. We invest in businesses that will stand the test of time. And we think our biggest advantage is that we take a long-term time horizon and run a concentrated portfolio, whereas a lot of funds will have to take a short-term time horizon because their clients are short-term, and they invest in hundreds of companies. So we take a concentrated portfolio approach.
Perfect. And last question comes from Pranjay. What is your opinion on the recent advent of search funds?
Value in the private equity industry, right? So some of my greatest friends have incredible investment track records from taking companies private, helping rerun them, and investing in nice growing cash generative businesses. So I think we talked about it on an earlier panel. What's the difference between public equity valuation versus private equity valuation or venture capital valuation? In the end, it's all the same thing, right? If a company is taking their earnings and they're going from 100 million to $1 billion in earnings, then you will make money if you pay a reasonable price for that, if it's a good, sustainable business. So whether you're on the public equity side or the private equity side or SPAC or whatever vehicle you do, I think the key is, can you generate good investment returns through picking businesses that will grow over time? And some of the great private equity investors are excellent at putting in their management teams, restructuring the businesses. So yeah, good question.
I just want to take a minute and thank everyone for showing up today. And of course, all of our speakers today. We had David Lee, Adam Milson, Kelly Fuller, Suzanne Sarka, and of course, our very own James Fletcher take time out of their day today to speak to you all. So I really wish you guys a fantastic future in Young Investor Society, and I hope to see everyone in our stock pitch competitions coming up. And then next week we have our stock pitch prep night, where we'll have previous global stock pitch winners. We'll also have guest judges to prepare you for those upcoming stock pitch competitions. So thank you very much for your time today, and I will see you.